A very good morning to all of you. As we have decided, in this session, we are going to take up the topic foreign exchange risk management. So let me remind you, these are revisionary classes for CMA final exam students, and because these are revisionary classes, my objective will be to take you through a rapid revision. So do not expect that we will go deeper into the concepts over here. Everywhere where some little deeper concept discussion is required, I will give you reference of a particular video link. You can watch the detailed concept over there. As of now, let us focus on revising foreign exchange risk management. So if you see your institute study material, they have divided this whole chapter into various small segments. It is, I think, third or fourth segment where they have titled foreign exchange risk management. So my objective is not to just focus on that particular unit. My objective is to give you coverage of the whole chapter, where you can in short call the whole chapter as forex. So it is beginning with foreign exchange markets, where basic fundamental things like exchange rate, direct quote, indirect quote, two-way quote, conversion of a quote from direct quote to indirect quote and vice versa, dealing with cross currency calculation, what are spot rates, what are forward rates, how to determine forward points, how to use forward points to arrive at forward rates, what is arbitrage, what is interest covered arbitrage, what is triangular arbitrage. Then we talk about interbank margins and determining exchange rates through interbank margins, and thereafter we have risk management techniques coming, where use of foreign exchange markets can be widely applicable for managing the foreign exchange risk. So what could be the causes of foreign exchange risks and how to mitigate those, where we can have a lot of matter discussing with respect to the foreign exchange risk management, various approaches for foreign exchange risk management, how to deal with each approach, and particularly when it comes to the manner of cancellation of a forward contract, how to deal with money market hedge, how to use currency futures, currency options, currency swaps and forward contracts under various situations. Under a given scenario, which of the hedging technique would be suiting best in the given situation, we will figure out that. There will be questions where whether a company should take a forward cover or not, or it should keep its exposure open. Now, what is the meaning of exposure? What are different kinds of exposures? There can be transaction exposure, there can be operating exposure, there can be different types of risks that a company can face. And most importantly, when you are dealing with foreign exchange risk management, see, you are not a bank over here, keep that thing in your mind. Unless the question puts you in a situation that you are a bank or you are an authorized dealer, that time you take your role as a bank or authorized dealer. Otherwise, keep your mind very clear. Generally, who would plan risk management in foreign exchange market? Either the party will be importer of goods or exporter of goods and services. So importer of goods and services, exporter of goods and services, they have outstanding foreign exchange dues, and there the foreign currency payables or foreign currency receivables become the typical cause of risk, and to manage that risk they are planning foreign exchange risk management. So understand one thing, the whole scenario will be drafted always from the viewpoint of an importer or exporter, and therefore don't presume yourself as a banker over here unless the question typically brings your role as a banker. So let us do one thing. Let us quickly go through the basic concepts over here, and here we are talking about the first concept, that is, what is an exchange rate? An exchange rate is a rate at which a currency can be exchanged with the other. It is a rate at which a currency can be expressed in terms of the other, or a currency can be bought or sold. There is a rate at which a currency can be bought or sold. For example, if I say $1 equals to rupees 75, it is clearly an example of an exchange rate. Now, every day when I am taking your revision classes, I have been instructing you one thing very clearly. We cannot afford to write everything. So, as and when I instruct you to note down certain things, noting down over here will not mean noting in your notebooks. You keep taking the screenshots as and when required. So, quickly take note of this. That means take a screenshot of this and I take you ahead. Alright friends, let us move ahead, and the next concept is about direct quote and indirect quote. Now, we have taken one example of an exchange rate as $1 equals to rupees 75. Now, whether this quote is a direct quote or indirect quote, how will we observe? Look at one thing. Looking at this quote, $1 equals to rupees 75. Just use your brain. Is it a quote given for 1 unit of dollar, or is it a quote given for 1 unit of rupee? Obviously, it is quote given for 1 unit of dollar. Correct? Because $1 has a price of rupees 75. So, what is the intention of putting forward this kind of quote? Intention or objective of putting forward this kind of quote is, if you are buying or selling dollar, the applicable amount as a rate of that dollar is rupees 75. That means the price is quoted for a unit of dollar. That means dollar is behaving like a commodity. Now, what do we mean by dollar behaving like a commodity? For example, if I am selling this product, it's a AC remote control. If I am selling this product, I will quote the price of this. Say, price of this is rupees 800. So then there is no confusion, right? Price is given for this remote control. Then there is no ambiguity, there is no confusion, because this is a commodity and the price is quoted in monetary form. But what is problem over here? In this exchange rate, dollar is not a commodity, dollar is money. Rupee is also money. Because both are money, you are not able to understand whose price is quoted. But if you closely observe the pattern in which the exchange rate is given, it is 1 unit of dollar expressed in terms of rupees. It is implied that you would want to buy or sell dollars. That is why the price of dollar has been quoted. So when dollar has its price quoted in the market, it is implied that it is dollar that is behaving like a commodity. So in this case, this is a quote given for 1 unit of dollar. Now, how will you interpret this as a direct quote or indirect quote? Now, let us talk about an entity operating in India. For that entity, dollar is a foreign currency and Indian rupee is the local currency. So, when the quote is expressed for 1 unit of foreign currency in terms of local currency, it is a direct quote. Inversely, if the quote is given for 1 unit of local currency in terms of foreign currency, it will be considered as indirect quote. So let us note down certain important points with respect to this particular example. In the above quoted exchange rate, the quote is given for 1 unit of dollar. In this given quote, dollar behaves like a commodity. For an entity in India, dollar is a foreign currency. The given quote is for 1 unit of foreign currency. This is a direct quote. So quickly take note of this and then I take you ahead. Taking note means take a screenshot and I take you ahead. Alright, I'm sure you have done the needful. Let us move forward. If $1 was equivalent to rupees 75, what would be the value of 1 rupee against dollar? If 75 units of Indian rupee were equivalent to 1 unit of dollar, 1 rupee is equivalent to 1 by 75 units of dollar. So rupee 1 equals to $1 by 75 is just the another variation of that rate. But look at this rate now. This is indicating that you have quoted the rate for rupee. Means you have quoted an exchange rate for Indian rupee and you would want to buy or sell Indian rupee. If you want to buy or sell Indian rupee, it is Indian rupee that is behaving like a commodity over here. If Indian rupee is behaving like a commodity over here, obviously the quote is given for 1 unit of Indian rupee, which is behaving like a commodity. For an entity in India, this is an indirect quote. For an entity in the US, it is a direct quote. So carefully understand, when 1 unit of local currency is expressed in terms of foreign currency, it will be treated as an indirect quote. So let us write some notes about this. In the above quoted exchange rate, the quote is given for 1 unit of rupee. In this quote, rupee behaves like a commodity. For an entity in India, rupee is a local currency. The given quote is for 1 unit of local currency. This is an indirect quote. So quickly take the screenshot of the same and then I take you ahead. Alright friends, I am sure you have done the needful. Let us move forward and write up some important notes over here. In a direct quote, 1 unit of foreign currency is expressed in terms of local currency. In an indirect quote, 1 unit of local currency is expressed in terms of foreign currency. Now sometimes let us take a different example. Suppose I say USD1 equals to JPY 112, means 1 unit of US dollar is equal to 112 units of Japanese yen. So USD1 equals to JPY 112. Now is this a direct quote or indirect quote? So what is given? Quote is given for 1 unit of US dollar. For an entity in Japan, it is definitely a direct quote because it is expressing quote of a foreign currency in terms of local currency. For an entity in the US, it is an indirect quote. What about an entity in India? If an entity in India is identifying this quote USD1 equals to JPY 112, how will Indian entity classify this? Direct quote or indirect quote? The answer is, it is not to be identified as direct or indirect. There is no need to classify. You need to classify a quote as direct quote or indirect quote only in the situation where one of the currency in the quote must be your local currency. If none of the currencies are local currencies, in other words, if both the currencies given in the quote are foreign currencies, for you, that means entity in India, that quote will not be classified as direct quote or indirect quote. So I have given that one additional point. In order to classify the given exchange rate as direct quote or indirect quote, one of the currencies in the quote must be the local currency. So quickly take the screenshot of this note as well and then I take you ahead. Alright friends, time for us to move ahead. Let us talk about concept number 3, that is two-way quote. Now what is a two-way quote? See, when you go to a bank and you ask price of any foreign currency, they would first ask you a question that you are asking the price for selling dollars or buying dollars. Obviously, a bank or an authorized dealer, they are typically dealers in the currency. They treat currency as their stock in trade, correct? Because they are carrying out business of buying and selling currencies. Obviously, they'll be buying the currency at a wholesale rate and selling the currency at a retail rate. That is how they carry out their business. So the rate at which they buy and the rate at which they sell has to be two different rates. Now, when I use the term like buying rate and selling rate, it can create n number of confusions. Because when I say buying rate, buying rate for the customer or buying rate for the bank or buying rate for importer or buying rate for exporter, nothing gets clarified. When I say buying rate, selling rate, it creates confusion. Therefore, we have technical terms like bid rate and ask rate. Bid rate is the rate at which bank will buy. Ask rate is the rate at which bank will sell. So here, bank will quote the exchange rate or a dealer will quote an exchange rate. So banks and dealers who are quoting these exchange rates, they will necessarily quote these rates in a two-way format. One is the rate at which they would buy, that is the bid rate. One is the rate at which they would sell, that is the ask rate. Let me give you an example. A two-way quote indicates a set of two different rates of exchange known as bid rate and ask rate. In a two-way quote, the rate at which bank will buy the currency and the customer will sell the currency is known as bid rate. The rate at which bank will sell the currency and customer will buy the currency is known as ask rate. Let me take you ahead and give this example. So $1 equals to rupees 75 to rupees 76. How would you interpret this particular rate? This is a two-way quote. This is an example of two-way quote. So if you are going to a bank and bank is giving you this kind of exchange rate quotation, it is clear that you as a customer, when you have to buy dollars from the bank, bank would charge rupees 76 for each dollar. But when you have to sell dollars to bank, bank will give you only rupees 75. So 75 in this example is a bid rate. Now what is the meaning of bid rate? Bid rate is the rate at which bank or authorized dealer will buy the currency and the customer will sell the currency. Ask rate is the rate at which the bank will sell the currency and customer will buy the currency. So ask rate will always be higher than bid rate, correct? Ask rate will always be higher than bid rate, otherwise bank will not be able to make a margin. So difference between bid rate and ask rate typically indicates the margin for the bank, and that margin is known as spread. So if you want to determine the spread in a two-way quote, you always take ask rate minus bid rate. For example, in this given exchange rate, ask rate is 76, bid rate is 75. So for each dollar, bank is having a margin of rupee 1 or a spread of rupee 1. Spread is technically a better term because later stage, what is the exact meaning of margin? I'll explain that. So margin and spread are two different things. Here I am using both of the terms as if they are common terms, but they are not common. That is why technically you should always use the term spread over here. Later on, I'll tell you what are interbank rates and what are margins applicable on those rates to arrive at the retail rate to be quoted to the end customer. So let me just give you an opportunity to take the screenshot of this note and then I take you ahead. Alright friends, I'm sure you have done the needful. Let us move ahead and let us talk about conversion of quotes. So you have already seen $1 equals to rupees 75. So rupee 1 will be $1 by 75. So what did we do? We took inverse of 75 and we got the other way quote. So taking inverse of a quote will give you the other format of the quote. So you can conclude by writing inverse of a direct quote will be an indirect quote and inverse of indirect quote will be a direct quote. So quickly take screenshot of this line and then I take you ahead. Alright, you would have done the needful. Now here you have to take precautions while converting a two-way quote. What kind of caution you need to exercise? When you are converting a two-way quote, inverse of direct quote will be an indirect quote and inverse of indirect quote will be a direct quote. That is clear. But while converting two-way quote, what precaution you have to take? Inverse of bid rate of a direct quote will become ask rate in an indirect quote. Inverse of ask rate of a direct quote will become bid rate in an indirect quote. quickly take screenshot of this as well, and then I'll explain you this whole thing by an example. All right, time for us to move ahead to take up an example over here. Let us take this question, and what is given over here: if the two-way direct quote is $1 equals to rupees 74 to rupees 75, how will you convert the same into a two-way indirect quote? Answer for this question: this can be done by inverting the rates given in the quote. Now can you notice 74 is the bid rate in this quote? So when you take inverse of 74, it will definitely become the indirect quote. But 74 itself is a bid rate in this quote. When you take inverse of 74, it will become indirect quote, but it will represent the ask rate of that indirect quote. Means inverse of the bid rate will become ask rate, and inverse of the ask rate will become bid rate. So the inverse of ask rate in the direct quote shall become bid rate in the indirect quote, and inverse of bid rate in the indirect quote shall become ask rate in the direct quote. So let me explain this point very clear through this working. Now in the given example, rupees 74 to rupees 75 was the direct quote given. So this is the direct quote. Now what is the bid rate in this? 74 is the bid rate in this, 75 is the ask rate in this quote. Now when you are taking the inverse of bid rate, it actually becomes ask rate. When you are taking the inverse of bid rate, it is becoming ask rate. So what is the inverse of that bid rate? It is rupee 1 equals to $1 by 74. This will become the ask rate. Likewise, if you are taking the inverse of ask rate from the direct quote, it will become bid rate. So what was the ask rate over here? 75. You take inverse of that, it becomes 1 by 75. So rupee 1 equals to $1 by 75. And finally, when you identify, this becomes the indirect quote. So when you pick your calculator and determine the value of 1 by 75, what you will get? And also determine the value of 1 by 74, what will you get? You get actually the quote of a rupee as rupee 1 equals to $0.013333 and $0.013514. And look at this, this is the ask rate. Ask rate always has to be greater than the bid rate. That simple philosophy has to follow. So please carefully take note of this whole thing. Take a screenshot of this, try understanding this, and then I take you ahead. Alright friends, let us move ahead, and now we talk about understanding the quotes. Now what happens, a bank or an exchange dealer can give the quote in different styles. The easiest way to give a quote where no one will ever get confused is when you give it in an equation form, that USD 1 equals to INR 68. But in forex market, you don't find always exchange rates given in this lucid manner. Sometimes it may create confusion. For example, they may give you the quote as INR per USD equals to 68. When I say INR per USD equals to 68, how do you interpret this? INR per USD. When I say INR per USD, it indicates the quote of USD in terms of INR. So when you get quote in a numerator denominator form, you will always read it like this: INR per USD. This time it is a quote of USD, because how many Indian rupee you need to pay for 1 unit of USD? INR per USD. That is the format of this quote, and it is obviously going to be 68, because 68 Indian rupee will be equivalent to USD 1. Obviously, I'm not talking about the rate prevailing right away. This example, when I have taken, it was long back. So this today would be what? Some $1 would be priced as rupees 83 or 84 in today's market. So INR per USD is 68. How you interpret this when it is given in numerator denominator form? Quote is given for 1 unit of this dollar, that is 1 unit of the currency which is there in the denominator, and it is given in terms of INR, that is in terms of the currency which is stated in the numerator. Now in the international forex market, the style of quote is always given this way: USD slash INR, that is equal to 68. This is the standard manner in which the quotes are given in international forex market. Now how do you interpret this? It is a quote of USD in terms of INR. You may also find this slash missing. It is simply USD INR quote. USD INR. What is coming first is USD, what comes later is INR. The manner in which you interpret will be quote of USD in terms of INR. Now sometimes when you are writing exams in India, CA Institute, CMA Institute, what kind of questions they put forward in exams could be confusing. Let me give you a point over here. They may give you an example like this: INR slash USD equals to 68. Now it is impossible that you interpret this as quote of INR in terms of USD. You cannot do that, right? Quote of INR in terms of USD, if you try doing that, means 1 Indian rupee is equal to 68 US dollars. It is impossible thing. When they give you a quote in this format, don't interpret it the way international forex market are presenting the quotes. You interpret this thing exactly in the same manner as you interpret INR per USD. Then take this as numerator denominator form. That means the quote is given for 1 unit of USD in terms of INR. Simple common sense. You know that between Indian rupee and US dollar, it can never happen that 68 units of US dollar will be equivalent to 1 unit of Indian rupee. So it is obvious that it will be 68 units of Indian rupee that will be equal to 1 unit of dollar. Now the moment I explain this, students ask me a query that, sir, here we are knowing that it is USD and INR, so we know the parity between the two. What would be the value of USD in terms of INR? We know, therefore we will not make mistakes in interpreting. So what would happen if there is some unknown currency given in the question, and then how will we interpret? See, in exams, question will give you some currencies which are known to you, and based on that you will get an idea, because by far I have never seen an exam paper giving information which is not capable of being interpreting correctly. Somewhere or the other hint will be given, and basically you will catch the objective of the information given. Misinterpreting the question's requirement will make your entire solution go wrong, and that is where experience of reading and interpreting questions is important. So I keep recommending students in forex chapter that more than solving questions, you develop that tendency of reading and understanding a question, because that will be more important. Because once you have understood the flow of calculations, you will not commit mistakes in making the calculations. Generally what I see where students go wrong is they wrongly interpret the question's information. That is where they go wrong. And if you have that experience of reading and correctly interpreting the question's information, you will not commit those mistakes. Let us take one more example. Another bank, Bank B, is quoting 1 GBP in terms of USD as USD 1.35. So if you put it in the numerator denominator format, it will be USD per GBP given as 1.35. How do you interpret this? Number of units per unit of GBP will be 1.35, means the quote is given for GBP in terms of USD. The idea is the same. GBP 1 equals to USD 1.35. The same quote in the international forex market will be stated as GBP in terms of USD, that is GBP slash USD, or you can simply say GBP USD 1.35. How do you interpret this line? Quote of GBP in terms of USD. Between GBP and USD, GBP, that is pound, is more valuable currency compared to US dollar. As a result, when in exam you find a quote like this, USD slash GBP equals to 1.35, do not interpret this quote as international forex market terms. Interpret this quote in this manner, that is, this is just like USD per GBP, which is given as 1.35. I believe by far you have understood what I am trying to convey in terms of understanding the quotes. It is very, very important to understand the quotes, because if you wrongly interpret a quote, the whole solution goes wrong, because you will just do the calculation the other way. Let us now, or let me give you an opportunity for you to take the screenshot of the same, and then I take you ahead. All right, you would have done the needful. Time for us to move ahead. Dealing with cross currency. Now, Bank A has given a quote of USD 1 equals to INR 68. I have taken the same example. Bank B has given a quote of GBP 1 equals to USD 1.35. And the question is asking you determine the cross rate between INR and GBP. You know, this could be a very, very important aspect in your exam, determining cross rates. So quote of USD is given in terms of INR, quote of GBP is given in terms of USD, and you have to find through this interrelationship what would be the quote of GBP in terms of INR. How would you do this? See, there are two different approaches. One is a mathematical approach and one is a logical approach. Mathematically, how do you do this? INR per GBP is what you have to find. Mathematically, when I say you put everything in a numerator denominator form, look at one thing. INR per GBP in numerator denominator form will be equal to INR per USD into USD per GBP. Logically, if you look at the right hand side of this equation, INR per USD indicates how many units of INR will be there for each unit of USD. So INR per USD you can obtain from quote given by Bank A, correct? You can identify from quote given by Bank A. Secondly, USD per GBP you will be able to identify from the quote given by Bank B, because GBP 1 equals to USD 1.35 is similarly expressed as USD per GBP, that will be 1.35. So you can obtain this rate from Bank B. Now look at the right hand side once again. It goes this way: INR per USD multiplied by USD per GBP being mathematical expressions. Here USD is in the denominator, here USD is in the numerator. What will happen? Both these USDs will get cancelled out, and what you will ultimately find in the right hand side is INR per GBP. In other words, if you want to find INR per GBP, you multiply INR per USD into USD per GBP, and you get INR per GBP as 68 into 1.35. As I told you, this quote INR per USD you can get from Bank A, which is 68. USD per GBP you can get from Bank B, which is 1.35. So 68 into 1.35. So 68 was the quote of INR per USD. 1.35 is the quote of USD per GBP, and when you are multiplying these two, you will be getting 91.80. This 91.80 is nothing but the quote of GBP in terms of INR. So you will write INR per GBP equals to 91.80, or you can conclude that cross rate between INR and GBP is GBP1 equals to INR 91.80. So please carefully take note of this example, and then I take you ahead. All right, you must be ready to move ahead. Let us take a calculative example. Question number 2. Can you notice the quote is given for pound in terms of dollar, and the quote is also given for dollar in terms of rupee. Question is asking you 4 different calculations. I would give you around 2 minutes time to figure out these calculations. Let me see if you can get the correct answers. Let me see if you can get the correct answers. I am finding that students are responding by giving answers. So let me now show you the calculations and you can check whether you were correct with the same or not. So when we attempt the solution of this question, rupee per dollar was given as 74, dollar per pound was given as 1.35. Cross rate for rupee per pound we can find by taking multiplication of rupee per dollar into dollar per pound. You get the dollar cancelled out and you simply multiply 74 with 1.35 to arrive at the value of rupee per pound, and what you get finally is 99.90. So this indicates clearly that 1 unit of pound is equal to 99.9 Indian rupees. Once you get this quote, then answering any of the requirement is very simple. Amount of rupee for pound 2200. So because pound 1 equals to rupees 99.90, pound 2200 will be simply 2200 into 99.90 per pound, and that comes to 2,19,780 in terms of Indian rupee. Second question, amount of dollar for rupees 8,14,000. Simply take $1 equals to rupees 74. So rupee 1 will be $1 by 74. So rupees 8,14,000 will be 8,14,000 into 1 by 74, and that would give you $11,000 as the answer. Third part of the question asked you amount of pound for $3,240. So take $1 equals to, pound 1 equals to $1.35, and so $1 will be basically 1 by 1.35 pound. So $3,240 will be 3,240 divided by $1.35 per pound, and what you will get is pound 2,400. And the last part of the question was amount of pound for rupees 70,000. Because pound 1 is rupees 99.90, rupee 1 will be pound 1 by 99.9, and so rupees 70,000 will be 70,000 into 1 by 99.9, and that gives you pound 700.70. So that will be the end of the solution. Let us move ahead and talk about dealing with cross currency in a two-way quote. Now here something very important, I would want you to take note of this. While multiplying the exchange rates for cross currency calculations in a two-way quote, bid rate should always be multiplied to bid rate and ask rate should always be multiplied to ask rate. Now many students learn this particular concept in different styles, in different ways. My strong advice to you is this particular point, don't take the screenshot. I would want you to write down in your notebooks, because this is the backbone of the entire forex chapter. If you mess with this, everything goes wrong. So my strong recommendation, I'm giving you a couple of minutes, please take note of these lines and then I take you ahead. Alright friends, I'm sure you have noted down these points. Now, this is not something to be remembered as a rule. It is something very, very logical. Let us try to understand this through a question. Now, in this question, what is given? $1 equals to rupees 72.20 to rupees 72.80. Pound 1 equals to $1.30 to $1.35. Calculate amount of rupee required to buy pound 500 and amount of rupee obtained by selling pound 500. So basically, previous question that you solved and this particular question, one big difference in cross currency calculation, what you find is, here it is a case of two-way quote. Price that you pay for buying and price that you obtain by selling are going to be two different prices. In this case, you need to apply the fundamental concept that I have made you write just now. And as I told you, these are not rules that we are discussing, these are concepts. Concepts are always backed by reasoning. So I'm giving you a moment. Try computing both of these quickly and see if you can get the correct answer. Try doing that. This time I couldn't get anyone's answer. Either you are yet to compute it or you are not able to do it. Anyway, in either case, let me help you out with the solution over here. Please try to understand what was given in the question. It was a quote of rupee per dollar, that is 72.2 to 72.8. Another quote was dollar per pound, that was 1.30 to 1.35. So cross rate for rupee per pound will be obviously rupee per dollar into dollar per pound, and you know that in the right hand side, dollar in the denominator over here in this expression, dollar in the numerator over here in this expression will get cancelled out. And now the problem is, if you multiply rupee per dollar with dollar per pound, you will be getting the value of rupee per pound. You have to multiply rupee per dollar with dollar per pound, but we have two values of rupee per dollar. One is bid, one is ask. We have two values of dollar per pound, one is bid, one is ask. Now which rate should be multiplied to which one is the question, right? And that is where the fundamental principle comes into picture. Bid rate should always be multiplied to bid rate. Ask rate should always be multiplied to ask rate. So if you want to find rupee per pound bid rate, you will multiply 72.2 to 1.3 and what you are getting is 93.86. When you multiply the ask rates, it will be 72.80 into 1.35 to obtain rupee per pound ask rate. When you multiply both the ask rates, what you get is 98.28. So the two-way quote for pound will be given as pound 1 equals to rupees 93.86 to rupees 98.28. Now you can answer those two questions. Amount of rupee required to buy 500 pounds. Because you want to buy 500 pounds, you will apply the ask rate, and that comes to 500 into 98.28, that is rupees 49,140. And amount of rupee obtained on selling 500 pounds will be 500 into the bid rate, that was 93.86, and that would be rupees 46,930. So please note down this entire calculation, and in case you have any point that is not clearly understood, you can just let me know. Alright friends, I am sure you have noted down this whole thing and understood the whole point. Please take a moment to mention in the comment section two possibilities. Would you want me to explain the reasons behind this, or you are clear with this already? You need to mention in the comment section. You want extended explanation to this, then I'll put time for that. If you are okay with this, I will just move ahead. So I want your signals over here. Without that, I will not proceed ahead. So I'm waiting for your signal. Please write in the comment section what you want me to do. Whether logically should I explain you the reason behind why bid rate should be multiplied to bid rate, why ask rate should be multiplied to ask rate, and so on. If required, mention it. If not required, mention it. What response I am getting is that you need not go into the details. You are already clear with that. Fine then, let us not stick to this and let us move ahead with the next concept. So concept number 7, spot rate and forward rate. Something very simple. Spot rate is basically the rate for immediate transaction. Forward rate is a rate for a future transaction. So why you need a forward rate? Suppose you have an outstanding payment that is to be settled after 3 months, or you have an outstanding receivable that is to be collected after 3 months, and you want to have a freezing of a rate. That means you want to fix a rate today itself, which will be applicable for a future transaction, but the rate has to be agreed today. Then you talk about that rate as a forward rate. So what we do is, what we do is, I'll just give you the meaning of spot rate and forward rate. Spot rate is applicable for buying or selling currencies at the spot. Forward rate is agreed today, but it is applicable for buying and selling currencies at a future specified date. Take note of this quickly so that I can explain you something about forward exchange contracts. All right, let us move ahead and understand something about forward exchange contracts. Now, what is a forward exchange contract and what will be the role of a forward exchange contract? Look at one thing. A forward exchange contract is a contract between the customer and the bank. Customer could be either an importer or an exporter. Counterparty will always be bank or authorized dealer. Why you want to enter into this kind of contract? Because it will give you an opportunity to hedge. So let us take an example that what would be the opportunity to hedge, and let us read out this content. A contract under which an entity has the right as well as obligation to buy or sell currency at an agreed rate at a specified future date, that is a forward exchange contract. A forward exchange contract can provide an opportunity to hedge foreign exchange risk. So let us take an example to understand this. X Limited requires to pay $10,000 to its creditor after 3 months from now. The company enters into a contract with bank to buy $10,000 after 3 months at a contracted forward rate of rupees 69 per dollar. After 3 months from now, X Limited will settle this contract and buy $10,000 at rupees 69 per dollar, irrespective of the price of dollar prevailing on that date. Now look at this one thing. See, you had to make a payment of $10,000. If you have a need to make a payment of $10,000 after 3 months, from now and after 3 months, the price of dollar is not going to remain constant. It is going to fluctuate. So you have to pay in US dollar. Now, what if at later date the price of dollar goes on increasing, 70, 71, 72? More money will flow out of your pocket. That is your risk, correct? You approach a bank or an authorized dealer and you enter into a forward exchange contract with them. You ask them that you freeze the rate today, you fix a rate today. Later date, when you have to make the payment, irrespective of whatever rate prevailing on that date, whether favorable or unfavorable, you will be eligible to buy those $10,000 at that rate. So the given forward rate in this example is rupees 69 per dollar. So you will be eligible to buy rupees 69 per dollar at that rate each dollar. In other words, you will be eligible to buy $10,000 at the rate of rupees 69, irrespective of the spot rate prevailing on that date. So if the price of the dollar is 70, but you will buy it 69. If it is 71, you will buy it 69. Whatever be the price of dollar, you will buy it 69. Even if the price of the dollar would have declined, you will not be able to take that advantage. You will have to pay 69 per dollar because that is your right as well as obligation. It is basically a forward contract. Just the way you have seen in derivatives what are forward contracts, same way in forex market, forward contracts in exchange market are generally called as forward exchange contract. Basically, the word exchange over here talks about foreign exchange markets. So a forward exchange contract is typically a forward contract. It will give you right as well as obligation to settle that contract. So moving forward, we will now talk about appreciation and depreciation. So once we have understood what are spot rates and forward rates, if forward rate is higher than the spot rate, we say that the quoted currency is considered to appreciate. Forward rate lower than spot rate, we say that the quoted currency is considered to depreciate. Quickly take screenshot of this note so that I can explain this further by giving examples. Alright friends, once you have taken note of this, let me take you ahead and give you an example. Spot rate is USD1 equals to INR 63.6. Forward rate is USD1 equals to INR 64.20. How would you interpret this particular situation? At the spot, 1 unit of USD is quoted as INR 63.60 and at a forward rate, it is quoted as INR 64.20. The forward rate of USD is greater than its spot rate. I repeat, forward. First, you understand that in this example, the quote is given for USD, right? And the forward rate is greater than the spot rate. So USD is cheaper now. USD is going to become little expensive later. That is the indication over here. That means the USD price is going to rise. And when USD price is going to rise, we say that US dollar is appreciating against Indian rupee. In other words, Indian rupee is depreciating against US dollar. So in the forward market, dollar will be quoted at a high price compared to the spot, right? I'm talking about forward market. In the forward market, the dollar will be quoted at a little higher price compared to the spot. We say that dollar is quoted at a premium. If dollar is quoted at a premium, it is implied that the rupee will be quoted at a discount. So let me give you implications of this example. It is observed that dollar is appreciating against rupee and therefore rupee is depreciating against dollar. And we can consider that dollar is quoted at premium in the forward market and rupee is quoted at discount in the forward market. So please take note of this as well and then I take you ahead. All right, you would have taken note of this. Now, what happens, friends? It is my request that if you really want to take advantage of this particular session, for every upcoming example when I put forward, I would want you to put a little time and effort behind this. Because this particular video is not just about watching what I am saying and hearing to what I am saying. It is about your involvement. If you can make your involvement at a good level, your understanding will become much smoother. And it is okay to commit mistakes, because if you are committing mistakes, it will give me an indication that your point is not clear over there. I'll help you out to give you that clarity. So my point is, don't bother about what if your answer goes wrong. Without hesitation, feel that comfort, correct? And suppose you end up giving lots of wrong answers and that is recorded in my YouTube video comment history. I promise you I'll delete all the comments, but don't hesitate, just try giving answers, because I'm going to show you questions which will be giving you some very good idea and understanding about this particular concept of computing premium and discount. Initially, I'll be giving you some moderate level questions. Gradually, if you are willing to solve challenging questions at later stage of the class, I have very good quality questions in forex. We will deal with those questions anyway. So here we are talking about premium and discount rate calculations. Let us take an example. Suppose spot rate is USD1 equals to INR 64 and 1 year forward rate is given as USD1 equals to INR 68. Take an opportunity, try computing the premium rate and discount rate if possible. If you can do it, fantastic. If you cannot do it, I'll definitely help you out, but at least give a try. Don't sit idle. Don't wait for me to solve it. You try solving it. I have given you very simple and straight question. One correct answer, that USD premium rate is 6.25%. Can someone give me even the calculation of rupee discount rate? Can someone give me the calculation of rupee discount rate? Okay, look at one thing, how to deal with this particular situation. One thing is clearly observed, that for USD, for which the quote is given, its forward rate is greater than the spot rate. So one thing is clear, that USD is appreciating and the Indian rupee is definitely depreciating. So USD will be quoted at premium. What will be that premium rate? Simply observe this calculation. 64 is becoming 68. So price of USD is rising by 4 and the base price is 64, correct? So what you will do, 68 and 64 difference, you divide it by the base price. So 4 divided by 64 into 100 will give you the premium rate of 6.25%. So how to present that part of the calculation? Appreciation rate or premium rate of USD will be 68 minus 64 divided by 64 into 100. Mind it, the period of forward was 1 year, so we don't have to make any time adjustment. If the period of forward was shorter than 1 year, then you will have to fix it up, because this premium or discount rate should always be mentioned in terms of per annum. So 6.25% per annum. So the numerator will always be the difference between the spot and forward rate, and denominator in this case we took as spot rate because the quote was given for USD and premium also you are determining for USD. So quickly take note of this and then I take you ahead. Alright friends, you would have taken note of this. Now let me show you how to compute the discount rate of INR. In order to compute the depreciation rate or discount rate of INR, the numerator won't change, numerator will remain same, but the denominator this time will be 68 and the correct answer is 5.88% per annum. The numerator will always remain same. It will always be difference between the spot and forward. Denominator over here will be the forward rate. Reason is the quote is given for USD, but you are computing the discount rate for INR. So take note of this because none of you could give me the correct answer for this one. And let me know once you are done with it so that we can move ahead. Alright friends, if you are done and clear with this much, let us move ahead, and now what we talk about is computing fair forward rate. Let me explain this concept through an example that is given in question number 20, and the question conveys this information. Spot rate is $1 equals to rupees 64. Interest rate prevailing in India is 12%. Interest rate prevailing in the US is 7%. Determine the fair forward rate for 1 year. Now, please try to logically understand how to determine these fair forward rates. What happens? Many students are used to application of formulas and they fail to understand the simple logic behind any calculation. You try to follow one simple thing. At the spot, 1 USD is equivalent to 64 Indian rupees. Correct? So what is the interest rate prevailing in India? 12%. What is the interest rate prevailing in the US? 7%. So let us understand it this way. Suppose you become an Indian in this example and I'll be someone from the US. So today let us have equal wealth in our hands. So I will hold $1. You are Indian, you are holding rupees 64. Your wealth, my wealth, both are same. Correct? You are holding rupees 64, I am holding $1. Because I am a resident of US, I will invest US dollar in the US at 7%. You are a resident in India, you will be investing rupees 64 in India. So you will invest 64 at 12%. So 64, if you invest at 12%, after 1 year, what will it become? So 64 plus 12% is becoming 71.68. And if I invest $1 in the US at 7%, after 1 year, it will become $1.07. So logically, after 1 year, $1.07 that I am holding should be equal to, I am not saying it will be equal to, I am saying it should be equal to rupees 71.68. Let me show these calculations over here. So as I said, US, I am the resident of US holding $1. You are the resident of India holding rupees 64. I am investing US dollar at 7%. You are investing 64 rupees at 12%. After 1 year, wealth in my hand will be $1.07. Wealth in your hand will be 71.68. So after 1 year, $1.07 should be, once again I am saying I am not talking about that it will be equal to, I am saying it should be equal to, because if the present values were same, future values also should be same. So if $1.07 should be equal to rupees 71.68, what would be the value of $1? That value of $1, what we get is rupees 66.99, and that is the fair forward rate for 1 year. $1 equals to rupees 66.99. You may please take note of these logical calculations, and then I show you the formula based approach as well. I can see some of you are giving wrong answers, but it is fantastic. Please believe me, even if you are giving wrong answers, that is just fine, because you are trying to make calculations. Many a times what happens, giving a wrong answer makes you learn much better, because you come to know that this is not to be done, correct? So when you understand what is not to be done, you will definitely not do it again. Definitely not do it again. Some people, in fear of giving wrong answer, if they do not answer, they would not commit that mistake what otherwise they should have committed. Believe me one thing, no one in this universe can learn without committing errors. My suggestion to all the students is always one: you commit errors at the early stage, so that in examination you go flawless. You try to hesitate now, try to avoid errors now, errors will happen in exam. That time it will be critical. You better commit errors right in front of me, because I am not against you, I am at your side. I am there to help you out. So it is okay to commit mistakes, not a problem. If you are getting wrong answers, that is absolutely fine, but make sure that later stage you keep correcting yourself. Alright friends, let us try to move ahead and do this calculation using formula. So as per the formula, FFR equals to S into 1 plus IL divided by 1 plus IF. Let us define all these variables. So FFR is the forward rate, S is the spot rate, that is 64. IL indicates interest rate prevailing locally, that is 12%. IF indicates interest rate prevailing in foreign country, or interest rate applicable for foreign currency, which is 7%. So you will compute FFR by taking 64 into 1.12 divided by 1.07. When you make this calculation, what you get is 66.99. Through formula or through the logic, whatever you are doing, you should be able to get the correct answer. So please take note of this as well. In case you have any point of doubt, without hesitation put forward your doubt. I'll clarify that, and in case you have no doubt, we will just move ahead. All right, friends, I'm sure you have concluded this and you have understood this whole thing. So we would say fair forward rate for 1 year will be $1 equals to rupees 66.99. Moving forward, we have some parity theories, interest rate parity theory, purchasing power parity theory. I would request you all that if you haven't prepared these parity theories, I have designed beautiful videos on these parity theories. Please watch. My strong recommendation is please watch these videos on interest rate parity theory and purchasing power parity theory. And not only that, I would recommend that there are concepts of arbitrage, dealing with net position of the dealer, and dealing with 2 and 3 spot arbitrage, also known as triangular arbitrage. These are important concepts, but because of shortage of time in this revisionary class, I will not be able to go ahead in detail with these concepts. But for your reference, I have already recorded and uploaded videos on these concepts long back. You can just search for triangular arbitrage or spot arbitrage. You will be getting videos on that. Net position of dealer. You will be finding lots and lots of videos given on forex. And if there is any specific area or if there is any question in your material that you are not able to crack and you want my help, I have all the content readily available. For me, it will not take any time and effort. I can just put up that video for your reference for a few days. It will be available on my channel, but you need to be in interaction with me. Yesterday I have given you my office number, and in case you have any specific request, you can just put that request via WhatsApp to my team as well. My team will also help you out. Moving forward from here, the concept of swap points or forward points. Now what happens in the exchange market? You don't always get the forward rate readily designed. They will give you spot rate and they will give forward points. Through the adjustment of forward points, you will have to identify what will be the forward rate, and let us try to understand that concept. And I'll give you back to back a few examples for your clarity. Suppose spot rate is $1 equals to rupees 64.46. 3-month forward rate is $1 equals to rupees 64.76. It is obvious that dollar is appreciating against rupee. You can compare and find, right? Dollar is appreciating against rupee. Dollar is quoted at premium. Known, clear. But premium here is not expressed in percentage. Premium over here is expressed in points. Compare the last 2 digit over here after decimal. 46. Here it is 76. We would say the forward rate of dollar is at forward point of 30. Now these are premium points because dollar is appreciating. In other words, the forward points or premium points are 30 points. I would want you to take a screenshot of this quickly so that I can take you ahead with a lot of examples. And as I said earlier, at later stage of examples, I want you to give me answers. You should try giving me answers. Quickly take the screenshot of the same and then I take you ahead. All right, let us move ahead and let us take another example. Spot rate is given as $1 equals to rupees 64.1625. 1 month forward rate is $1 equals to rupees 64.1655. Again, if you compare, here it is 1625, here it is 1655. What is the difference? Difference is still 30 points. So whether it is 2 places after decimal or 4 places after decimal, you just compare and find out the gap, and the gap over here what we find is 30 points. Again, it is premium of 30 points because dollar is appreciating against Indian rupee. In this third example, we find spot rate given as £1 equals to $1.5650. This time I am giving you 2 months forward point, premium is 5 points. So what will be the forward rate? Now this is the reality situation, that in exams also you may not be given the forward rate directly, you will be given the spot rate. Along with that they will give you the forward points. Forward points, if it is premium you have to add, if it is discount you have to subtract. So you tell me one thing, how would you arrive at the forward rate? Now many students, what they do is they commit a silly mistake over here. What they do is $1.5650, correct? Now what they would do is 0 at the last place after decimal, mathematically it doesn't carry any weightage. So $1.5650 or $1.565, people interpret it same, and then they add 5 points to this 5, which is wrong. You don't eliminate this 0 ever, because this is a foreign exchange quote. Even if the last place after decimal is 0, let it be 0. Don't mess it up, don't round it off, don't convert it into 1.565 and then add 5 points. It is 1.5650. It is on 0 you add 5 points. So the answer will be £1 equals to $1.5655. I am giving you a moment. Quickly take the screenshot of the same. Alright friends, I am sure you have completed this. Let us move ahead and take up next example. Spot rate USD1 equals to SGD 6.8580. 2-month forward point given as discount is 15 points. Therefore 2-month forward rate will be, now you give me the answer. Come on, you give me the answer. What will be the 2-month forward rate? Because 15 points given as discount points. Answer will be, I'm waiting for your answers. So the obvious correct answer is USD1 equals to SGD 6.8565. Now let me give you one more example. Spot rate USD1 equals to HKD 7.8130 to HKD 7.8165, and 3-month forward points are given as 20/25 points. Now guys, you know what is happening over here. Here it's a two-way quote. Be cautious when you are dealing with two-way quote. Be cautious when you are dealing with two-way quote. How do you deal with this? Of course, there are set of 2 forward points. One is applicable for the bid, one is applicable for the ask. Before you add or subtract these points, you have to first identify whether these points are premium points or discount points. So because in the earlier examples I mentioned whether these are premium points or discount points, and it will always be mentioned when it is a single way quote. In a two-way quote, examination questions won't mention whether it is premium or discount. You have to figure out on your own. I will give you a task. You first tell me, what do you get indication from these points? Are these premium points or are these discount points? That you have to tell me first. Come on. Let us see if you can give me the correct answer. First, you tell me whether these are premium points or discount points. Come on. Premium points or discount points? Premium points or discount points? First, you tell me that. Come on, quickly. I am waiting for you. All right. It is definitely a case of premium points. It is definitely a case of premium points. Now, few things let me explain. Students sometimes mug it up that when the numerator denominator format given as swap points or forward points, numerator less than denominator means it is a case of premium. If numerator is greater than denominator, it will be case of discount. But people fail to understand the reasoning behind this. You should always be clear with the fundamental reasons. Of course, this is a fact that if the numerator is less than denominator, it is a case of premium without doubts. But if you would want to know why it is like that, there is a reason. See, assume that there are 100 banks which are dealing in foreign exchange. Each of these banks will deal in spot. But out of all these 100 banks, you ask them, do you provide forward contract? Do you provide forward contract? Do you provide forward contract? 95 banks will say, no, we do not provide. We deal only in spot. Only 5 banks out of 100 banks will be offering you forward contracts. That means competition among dealers in spot market is very high. Competition among dealers in the forward market is substantially low. Therefore, the spread that you find in spot and forward, spot spread will always be less, forward spread will always be greater. You interpret this as premium points. Premium points means these points should be added. Add 20 points to 8130, it will become 8150. Add 25 points to 65, it will become 8190. 8150, 8190, the gap becomes 40 points. The spread becomes 40 points. In the spot, let us identify the spread. 65 and 30, the spread is 35. Means what? In the spot, the spread will always be less. In the forward, the spread will always be greater. Second point, if you consider this as discount point, you would have subtracted, right? Kindly subtract 20 points from 30 and you will be getting 8110, and from 65 you subtract 25, you will get 8140. 8110, 8140, the swap points when subtracted, your spread is becoming 30 points in forward, but spread in spot was 35 points. So it is impossible that the forward will have a lower spread. Forward will always have a higher spread. That is why when the numerator is less and the denominator is greater, you will always consider this as a case of premium. And that is why over here 3 months forward rate will be USD1 equals to HKD 7.8150 to HKD 7.8190. So I'm sure you have understood this very well. Quickly take the screenshot of these examples and then I'll give you one final example to conclude this whole thing. Alright friends, I'm sure you would have taken the screenshot of this example. Let us go for a final check. I would expect you all to give me correct answer for this example. I won't say a word. I am just waiting for the correct answer. Come on. It's your role to play now. Give me correct answer. I'm sure this time I'm going to get the correct answers from each one of you. I'm not doubting. So better you also don't doubt. Just give the answer. So I'm getting the answers already, and let me now show you the final answer. It will be 7.8100 to 7.8140. This was definitely case of discount. Take the screenshot of this example as well, and then I take you ahead. Alright friends, time for us to move ahead. Let us note down some important points with respect to what we have discussed. I have explained you each of these points. I am displaying these important notes just for you to take a screenshot of the same, and then we move ahead. Yes, I could see comment from Divya. Divya, can you please elaborate what exactly should I explain once again? You mean the second point? Okay, no problem. I'll explain that second point again. It says the numerator indicates swap point for bid and the denominator indicates swap point for ask. Let me do one thing. Let me take you back to this particular example. See, whenever you have a two-way quote, forward points must be given for both bid and ask, right? For both bid and ask. When swap points have to be given for both bid and ask, they have to mention either separately. For the bid, this is the forward point. For the ask, this is the forward point. But if they don't mention, you tell me simply one thing. In a quote, in a two-way quote, what first appears is the bid rate and what next appears is the ask rate. So in swap points also, whatever first appears will be the swap point for the bid rate and what later appears will be for the ask rate. So for the bid and for the ask, the sequence will never change. It will always be first for the bid and next for the ask. That is why in that point that I have mentioned over here, it is a second point clearly indicating that the numerator will always indicate the swap point for bid rate and the denominator will always indicate the swap point for ask rate. I hope you are now clear with the point. Very good. Fine. So if you are all clear with this whole thing, let us try to now move ahead and let us deal with foreign exchange risk management. Now, various approaches for foreign exchange risk management. Approach 1, no hedging. Approach 2, invoicing in local currency. Approach 3, using forward exchange contract. Approach 4, leading and lagging. Approach 5, netting and money market hedge. Now, first of all, if I talk about no hedging, see, sometimes not hedging your foreign exchange risk could be the best course of action. But if you do not hedge, if you don't use any hedge technique, you are taking risk. It could be the best outcome in a given situation, but don't forget that you are still taking risk. Then invoicing in local currency. If you say that, boss, I don't want to get any exposure, I don't want to have any foreign exchange risk. Simple thing, if you are exporter, you simply say, I will prepare invoices in my own currency. The price of my product is rupees 5 lakhs. I will make invoice for 5 lakh Indian rupee and you pay me 5 lakh Indian rupee. So I will never take a risk. People consider this as one of the hedging strategy. It may not give you foreign exchange risk, but you know, you are dumping the burden of this risk on your customer. If you do that, doing so, you may take a bigger risk in your business of losing out that customer. See, simple logic. You know, today we make so much purchases from online portals, correct? Amazon, Flipkart, so many portals are there. Now, Amazon was the pioneer. When Amazon started its appearance, anyone who had to buy product from Amazon, the price was quoted in US dollar only. But now, the price is quoted in the customer's own currency. Earlier, Amazon was having straight policy. It was price will be quoted in US dollar only. They had limited range of products. Price will be quoted in US dollar. You want to buy this product, you pay in US dollar. So the burden was on the customer to convert the currency and make the payment in US dollar. Nobody would want to do that. See, nobody would want to do that is a different thing. Many customers are not capable of doing that. See, for making a transaction through bank, making a payment in US dollar may not be known by every customer as in how to do that, correct? Today there is a convenience. You have a credit card, you make the payment and the payment will be automatically converted by the credit card company or your bank, and the payment will be made in US dollar. Earlier, this kind of features were not available with the public. As a result, people had fear of making a transaction in foreign currency. Point is, the day Amazon found that in India there are local portals available which are offering same kind of products even at a little higher price, but they are providing the quotes in Indian rupee, people in India started buying their products requirement from those portals and not from Amazon. Amazon had no choice but to change its pricing policy. They started invoicing in customers' currency. They just could not afford to lose their customer base. So invoicing in local currency is not a very good strategy. Now, what is forward exchange contract? I have explained to you. In fact, I would say the biggest deal in the whole foreign exchange risk management will be always sticking to forward exchange contracts. Leading and lagging is yet another strategy. Leading and lagging, what is its meaning? I'll convey to you in a while. Netting and money market hedge is again a wonderful strategy. Money market hedge is such a beautiful way of planning your settlements in such a way that sometimes comparing through forward exchange contract, you will be actually better off dealing with money market hedge. What is all this? We will talk about that in detail. Let us have understanding of few more approaches. We have use of currency futures, use of currency options, use of currency swaps. So as I told you friends, these are revisionary classes. It doesn't allow me to go into full length discussion on each of these concepts. So you please mention in the comment section today after the session gets over, as in if you want me to go for elaborate discussion on any particular matter, I will try to see if there is a possibility to bring forward that particular discussion. I'll take maybe a small session separately on the same. Moving forward, we first talk about no hedging. No hedging, as I told you, is actually not a very good strategy. Sometimes it may be beneficial. So sometimes what happens in exam, they may give you various options. Hedge through forward contract, hedge through currency futures, hedge through money market hedge, or no hedging. Find the outcome of all four strategies and look at which one is giving you most benefit. The most beneficial strategy sometimes could be no hedging. But the moment you go with no hedging, you were lucky actually to get the maximum benefit out of that. But it could be the most risky thing because you are not planning any hedge. So in examination, keep in mind one thing, that you may resort to no hedging, but whenever you are suggesting no hedge in a particular question solution, you should mention a disclaimer. You always find people giving disclaimers. So you first say that, okay, among all the given alternatives, no hedging is the best strategy. Then you provide a note, a small note, that even though in this scenario the best strategy is no hedging, however, not taking any hedge will continue to put the company under exposure, and the company will be exposed to foreign exchange risk because nobody has seen the future. Anything can happen in future. Little adversity and you may be finding yourself into trouble if you go with no hedging. It is a risky step. So I'll just give you this note. If you are interested, you may take a screenshot of the same. All right, time for us to move ahead. Next thing, it is about invoicing in local currency. I explained you this, giving you Amazon example. Invoicing in local currency, there will be no foreign exchange risk. The fluctuation in the foreign exchange rate cannot affect the company. The amount receivable or payable is denominated in foreign currency. This approach passes on the risk, that is the foreign exchange risk, on the counterparty. The exchange risk is simply being avoided and not being hedged or managed. You do one thing, first you take the screenshot about this note and then I'll talk a little more about the same. Now see, when you start invoicing in local currency, you are not managing the risk, you are avoiding that risk. Risk cannot be eliminated, correct? Risk cannot be eliminated. If risk is there and you say I will not take risk, the counterparty will be involved in taking that risk. Counterparty could be your customer. If you are troubling your customer, asking customer to take the pain, asking customer to take the risk, see, this is a competitive world, correct? If I am doing some business over here, there will be thousands of competitors around me. One flaw they find in my business, they will take advantage of that. Why should I let anyone take advantage of my flaws? Best thing what I can do is give customer that comfort, give customer no chance of taking risk. So the ideal thing is, don't ever follow the strategy of invoicing in local currency. It will not help you manage the risk, it will push the risk to the counterparty. Fine, then let us move ahead with the next point, hedging through forward contracts. Now this I have explained you in the earlier concept, but what is further to be discussed over here, entering into forward exchange contract for managing exchange risk, that is hedging, is known as taking a forward cover. An entity has to take a decision whether a forward cover should be taken or not. Now let me explain this point over here. See, in exams and in your study material, you will be finding plenty of questions which are focusing on a scenario where you have to take a decision whether a forward cover should be taken or a forward cover should not be taken. So those kind of questions are decision making kind of questions to particularly decide whether a forward cover should be taken or not. But once you have taken a forward cover, then the follow up of that forward cover is another chapter in itself, because then there can be honoring of the contract, that is acceptance or settlement of the contract. There can be settlement of the contract before the due date, at the due date, after the due date. There may be cancellation of the contract. Again, cancellation can happen before the due date, cancellation can happen at the due date, and there is even a concept of late cancellation. There could be extension of the forward cover, that extension also termed as rollover. Now those concepts of rollover and late extension I haven't seen in CMA Institute study material. CA students, they have frequently asked questions in their exams. CMA students, by far none of the past exam questions, neither in the institute study material this kind of extended part is given, where it is about application of FEDI rules. FEDI means Foreign Exchange Dealers Association of India. It has set out its rules and there have been amendments in those rules as well. So if on your own interest, if you would want to look at what about late extension and late cancellation, I have given videos on my YouTube channel for the same, including the amended FEDI rules. So as of now, if you are writing exam this coming July, I will not recommend you to do that, because it is anyway not going to come in your exam. When I say your exam, I am assuming that you are CMA final student. If any CA final student is watching this video, this what I just asked CMA students to avoid, it is something very, very important in CA exam. So don't ever think of avoiding that. Anyway, if you are interested to take the screenshot of the same, this is the time for you to do that. All right, friends, time for us to move forward. Cost of hedging. Now see, sometimes say you are staying in a big city like Chennai, Mumbai, Delhi, Kolkata, some big cities. What will happen? You will be finding lots of dealers available to provide you forward cover. Imagine a small town where there is a limited number of foreign exchange dealers, or hardly one or two foreign exchange dealers, and they are not even dealing in forward contracts. But you want a forward cover, you approach them. So maybe one of the banks in some small town, they would say, okay, we are not providing forward cover, but our Chennai branch is providing forward cover. We can arrange that for you. We can arrange that for you. Now, they will not do this service freely, right? Because if they ask you, okay, you go to Chennai and get the forward cover, that is not sounding great. They will say, we will arrange this for you, but we will charge some fee for this. There may be that upfront fee payment that comes under the category as cost of hedging. Means to hedge your position, you have to sometimes incur cost. Even to take a forward cover, you have to incur a cost. So taking forward cover generally is cost free, costless. But if there is any kind of legal fee, any kind of stamp duty, any kind of documentation fee, any kind of commission given to the intermediary banker for arranging this kind of contract, those initial costs come under the cost of hedging. And if your hedge period is 3 months, suppose the payment is to be made after 3 months, then your final outflow, when you consider your outflow, will be considering the cost of hedging, not only the fee and charges that you paid at inception, even the interest factor of that should be considered. So let us write some important notes with respect to this. In some cases, the bank might charge an upfront premium for entering into forward exchange contracts. This amount will be an expense in the hands of the company. In fact, not only the premium but also interest arising on such premium will be a component of cost. Such premium along with applicable interest, if any, is known as cost of hedging. So if you have any payments to make, do one thing, no? First you take the screenshot. I'll provide you little more explanation after this. Alright, let me explain something more about this. You know, if you are an importer and taking a forward cover, incurring cost of hedging, your cost of hedging will be added to the outflow that you have to make to your supplier. Because you are an importer, you would have purchased goods, you have to make payment. That payment is an outflow, cost of hedging is also an outflow. Your overall outflow will be the payment finally made plus the cost of hedging. If you are an exporter, you have exported goods and you are going to receive payment, your final cash flow will be the money received on settlement minus the cost of hedging. There the net inflow will require subtraction of this cost of hedging from the final amount of inflow that you got from your customer. So you have already taken the screenshot of the same. Let us move ahead. And this is a very, very important point. Many students mess with this. Let me give you correct insight about this. Interest rates are always quoted in terms of per annum. Therefore, if 6-month borrowing rate is 12%, how would you interpret this? 6-month borrowing rate is 12%. How would you interpret this? 12% over here is not the interest applicable for 6 months, but the style of mentioning the interest rate, if it is like this, 6-month borrowing rate is 12%. 12% is always interpreted as per annum. I repeat, 12% is always interpreted as per annum. So what is the role of 6 months? The role of 6 months is the contract is for 12% per annum, but interest will be payable half yearly. That means it is showing, it is kind of giving you an indication that you have to make payment of interest on your borrowings every half yearly. It should be interpreted as 12% per annum, that is 6% for 6 months compounded half yearly, means it is implied that interest settlement has to be made half yearly basis. Likewise, another example, if 3-month borrowing rate is 16%, if this kind of language used in the question, how would you interpret the same? It should be interpreted as 16% is a per annum rate, but applicable for 3 months will be only 4%. So 16% is per annum, so 4% for 3 months. That means every 3 months you have to pay interest. In other words, the compounding will be done on quarterly basis. I'll give you a chance to take the screenshot over here, and please mention in the comment section, are you able to follow all these concepts, or if you have any confusion, please put forward your point without hesitation. All right, friends, you would have taken note of this. Let us move forward. The base rate in Indian money market in the form of a floating rate is called MIBOR, that is Mumbai Interbank Offer Rate. The base rate in international money market in the form of floating rate is called LIBOR, that is London Interbank Offer Rate. Now see, when we talk about interest rate in today's world, interest rate could be a fixed interest rate. That means interest rate won't change throughout the period of borrowing, but the modern style of providing the interest quotations is generally a floating rate. So the base rate, if changes, your floating rate would also change. So you would see that in India, the RBI is frequently announcing the rate, which is the rate applicable for interbank loans. We call that as repo rate, correct? Repo rate is the rate at which one bank will be borrowing or lending to the other bank. But when customers like you and me, we go to borrow, bank will add some margin on the repo rate. If the repo rate changes, your effective interest rate also changes. If your effective interest rate is changing, you need to understand that your repo rate is the base. But how do you deal with a floating rate in derivative market, in forex market, internationally? So international forex market is considering interest rate as LIBOR, that is floating rate base LIBOR, London Interbank Offer Rate, and in India it is MIBOR, that is Mumbai Interbank Offer Rate. Interbank offer rate is nothing but rate which is offered by one bank to another bank for borrowing or lending among the banks. So I'll just give you a quick moment to take the screenshot of this. Let us move ahead. If 6-month borrowing rate is LIBOR plus 0.8% and LIBOR is 4.5%, how would you interpret this? So LIBOR itself is 4.5%, that is per annum rate. Even the margin over here will be per annum. So how would you interpret this? 4.5 plus 0.8 makes it 5.3% per annum. That is to say, effective rate of borrowing for a period of 6 months will be 5.3% per annum compounded half yearly. It should be noted that quotation of interest rate can be in terms of basis points, where you should be knowing this point very clearly, that 100 basis points make 1%. So if the interest rate is quoted like this, we can alternatively write as LIBOR plus 80 basis points. Therefore, in the above example, the interest rate or interest quote can be given as LIBOR plus 80 basis points. I'm giving you a moment. Please take the screenshot and then I take you ahead. Alright friends, once you are done with this, let us move ahead to the next point of discussion, that is leading and lagging. Leading refers to making a payment before the due date. Lagging refers to making the payment after the due date. Sometimes it is beneficial to lead the payment, sometimes it is beneficial to lag the payment. So you should have this kind of arrangement with your counterparty. Let me explain it this way. Suppose I am an importer. I have to make a payment in US dollar and I find that the price of US dollar is continuously declining. If I pay now, what will happen? If I pay now, I will be able to make the payment at the current rate, whatever is the spot rate. But I know that if the dollar price is declining, I will be better off by lagging the payment. So what I will do, I will request the counterparty that, see, I am taking the foreign exchange risk. At least allow me the liberty to lag the payment, because dollar price is diminishing, dollar is depreciating. Let me take advantage of that. Maybe I'll pay you after 3 months so that I have lesser outflow, but you still get the same. On the contrary, I will also compensate you for the delayed payment by paying interest. Correct? Because nobody would want a delayed payment just like that. Delayed payment you can compensate by paying interest to the counterparty. So you have money in your hand, but right now you don't want to make the payment because you are waiting for the dollar price to come down. So money in your hand, you better invest in India. You earn some interest. You ask the counterparty, let them charge some interest for the delayed payment, but you will still be better off. So that is how we take decision that whether the payment should be made immediately or payment should be lagged. Whatever is giving you beneficial scenario, we go ahead with that. Inversely, if the dollar price is appreciating continuously, if I have a due date after 3 months, but I know that after 3 months the dollar will be rising up, for me it is better to pay now. You ask the counterparty that, see, I am settling the payment 3 months before the due date. Please give me some benefit of quick payment by reducing my obligation, and I am making the payment immediately. You will be benefited by leading the payment, because otherwise the dollar price was supposed to rise up. This is a beautiful concept. I have a lot of questions in leading and lagging, but as I said, right now in these revisionary classes, it will be very difficult for me to cover up all those calculative questions. So with this concept, leading and lagging, if I move forward, next concept is netting, followed by money market hedge. Now guys, what is the concept of netting? See, netting is basically a situation where you have a receivable, you have a payable, and you just offset your receivable and payable. Let me give you an example so that you better understand this. Suppose I have purchased an asset on 1/7/2022 for $1 lakh. So for me, I'm an entity in India. I have purchased an asset for $1 lakh. I have an amount to be settled on 31/12/2022. Correct? So I have a liability. I have a liability that is denominated in US dollar. I would say the company has a dollar denominated liability that is due on 31/12/2022. Coincidentally, the company also has a receivable of $1 lakh due on 31/12/2022. So one side, in the US, there is a supplier from whom I have purchased an asset, and I have a customer in the US who has to make a payment to me. Coincidentally, the amount of both the payments were also same, $1 lakh to be received, $1 lakh to be paid. Coincidentally, the due dates were also same. With all this coincidence, what I can simply do, I can ask my supplier to collect the payment from my customer locally over there. In other words, I will instruct my customer that instead of remitting $1 lakh in India, you directly give that payment to this party, and parallelly I'll instruct my supplier that, see, this party will be coming and making the payment of $1 lakh on my behalf. Please accept the payment. For me, a dollar denominated liability and a dollar denominated asset is getting set off. This is what we call as netting. Now here coincidences were present, but do you think such kind of coincidences will always exist? Obviously not. So here you took advantage of this and your customer ended up making a payment to your supplier. You did not have to receive $1, you did not have to pay $1. What is the price of dollar now, or what will be the fluctuation in the dollar price? It doesn't affect you. You are immune to all those fluctuations. But this is a coincidence, and these coincidences may not happen always. If you want to create such situations, that is what we term as money market hedge. A money market hedge is again a beautiful concept. So I have given detailed discussion on money market hedge with calculative examples to show you where money market hedge could be better than taking a forward cover as well. You may please refer to those videos of mine, and what I will do, I will also ask you to put forward your requests in the comment section, as in what are specific areas that you still want me to help you for. If you all are writing exam in this immediate coming term, I would want your preparation levels to be very good. I will do best from my side to render whatever possible help can be rendered from my end. You all have our office number. You have my YouTube channel through which you are connected. I will create a separate playlist for CMA final students for forex as well. So you don't have to hunt for videos. Everything will be arranged in that playlist. I'll provide you that playlist link as well. So here I will have to put an end to this particular session. One very strong suggestion is, do watch all those videos that I have recommended, and any help needed apart from these classes, you just let us know. We will be happy to help you out, definitely. So I wish all of you all the best for your upcoming exams, and I'll be just putting an end to this session. So please mention in the comment section how you were benefited with these sessions that I have taken for you, and what additional content you want me to provide to you. Please mention that without hesitation, and over here I'll be putting an end to this session. Thank you very much for attending these classes.